It's Sunday evening, May 20th, and I'm going to do an update on the gold market here. The gold market is in a potentially very interesting position. It may look straightforward as it is right now, but there's one scenario here that I think if it occurs, a lot of people would miss that one, and it could be a very explosive opportunity. So I'm going to go through this on a few different time frames and basically let you know what I'm seeing here. This is a daily chart of the GLD ETF first off. So this was the high on September 6th. Saw a leg down, a correction, a leg down, then we saw a correction. Now we have another leg down, which on the ETF didn't quite surpass the December low. However, the nearest futures contract did. So we could consider this actually being a continuation of the bear market right now, but let's just look at the technical analysis of this. First off, since May 7th, the Bollinger Bands have been expanding out, and the market's been gapping down and closing below those lower bands. It did that for about 7 days straight, and then we had this doji candlestick down here on May 16th. Large gap up the following day, nice bullish candlestick, and then some continuation there this past Friday. As of right now, that's a nice looking short-term bottom. The largest counter trend movement in this downtrend since February was right here, was 5 days, and was basically equal to this rally here. So if the market continues on up here and it gets larger than any of these counter trend rallies, and then if it takes more time than any of these counter trend rallies, that will be an indication that there is a correction of this entire leg down occurring. Personally, I don't expect that to actually lead to a new continuation of the bull market. I'll get into that here in a couple minutes why. On a short-term basis, there was a potential symmetrical triangle right here. Many times those occur in the next to last position in a pattern. So if this is something like an A, B, C type of pattern, then that would make sense that we are going to see a correction of this leg down here since there was a triangle pattern. Now the daily stochastics has been oversold for a week or so here and is turning up nicely at this point. I'm going to switch time frames here so that we can get a better look at this. I've switched over to a weekly chart here, and what you can see on the weekly chart is there's actually a very nice long setup here. Here's why. We have the weekly stochastics is actually oversold here, and the price has pulled down to the lower Bollinger Band and has reversed there. So on the surface, that looks like a nice long setup, and it may very well turn into a nice long trade. So you could use those signals here, but you definitely need to place a stop loss below these lows. I'll get into that here in another chart or two. Why you don't want to be without a tight stop below these levels here. Now the bearish part of this weekly chart is that there was a trend line, this red trend line here, going off the 2008 bear market lows in gold. There was a touch point, a touch point, and a touch point. Another touch point up there, and then the market broke through that. It came back, tested it from the downside. That's often a very nice long-term short entry signals when you get a retest from the underside of that trend line, assuming the market breaks down below that low there. You could see a major continuation move down from that point. So that's really the risk here. On a monthly time frame, here's what we're looking at. This is the stochastics on the monthly time frame. What you can see here is obviously the market was very bullish for months on end, and we've turned down on the stochastics out of overbought territory. And after starting to move back up, we now have another bearish cross in the stochastics here. So coming out of overbought territory, we have stochastics opening up nicely downwards on the monthly time frame. So while the weekly time frame is oversold and the daily time frame was heavily oversold, you should expect a bounce in that case, but the longer term current looks to be down here. So what you may expect is a rally of either a brief rally or even one lasting several weeks to allow the short-term pressure to be lifted from the gold market, but then potentially a continuation down based off of this monthly stochastics being pointed down. These dots here, this is a parabolic SAR study overlaying here. So as of December, there was a sell signal triggered in the parabolic SAR system. And in this whole entire bull move, those signals have been very nice. Once you've had a sell signal registered, allow the market to consolidate, and when a new buy signal is registered, they've been successful. It looks like basically every single signal on the parabolic SAR since the beginning of the bull market in 2001 in gold. So if you're on the fence here as far as possibly looking to trade gold or have some underlying interest in that market, it may be wise to wait for that signal to trigger, because they've been very successful. And if it doesn't trigger and we get a break of this support level, there could be a significant continuation down. And I'm going to show that on the gold continuation chart. In September, gold came down to this 1533 level on a sharp correction, then rebounded. In December, it came down to this 1525 level, had a nice rebound, and then we've come down right down to the 1526 level again here as of this month. So we have a very, very solid level of support right at this level in here. Now, there are three bottoms here. Very strong support level. We've had the market reverse up off of this level, so you could take a long trade and the stop be below these levels. But here's the part that a lot of people will miss. Whenever you have a market that establishes a clear support or resistance level, in this case a support level, and particularly if there are three bottoms to it, if the market rallies and then it fails at this and pushes to a new low for the fourth time, many times that will lead to a continuation type of move down, a waterfall type of decline. So if the market, say, does rally here for several days or even a few weeks, and then actually comes down and breaks this support level, there could be a major liquidation type of move, a very sharp type of move down in gold. And there's a few reasons for that. The smart money in the commitment of traders data, when you're looking at the large funds and the large commercial hedgers, the large funds were at an extraordinarily record net long position here as this bull market was peaking out. And while there has been this sideways action here for 2/3 of a year or so, they are still, on a historical basis, very net long, and they have a lot of potential selling to do before they have really kind of cycled back down to a potential buying level as far as the smart money goes. So the smart money hedgers will sell as the market gets stronger. So they're hedging their underlying interest. The other side of that position is that speculators are buying that, and they're going to continue to buy and follow the trend and push the trend higher and higher and higher as long as they have money to do so. However, they are trend followers, and when this market turns to a downtrend or breaks clear support levels, all those underlying funds, speculative funds that are responsible for the bull market, they are going to be forced to sell. So they're going to have stop losses under these support levels, and then at some point, once they start, the support levels are breached, it's going to lead to major, fast liquidations by all the speculative buyers, and they have a long way to go before they've really cleaned out their major net long position. I've talked about this in recent posts on the blog, but if we click over to a weekly chart here, this level down here around 866 would be an 86% retracement of the 2008 to 2011 bull market in gold. And given the long-term bull market in gold and this rise from 2008 to 2011, the bear markets or corrections to follow on average would be of many different commodities, not just gold commodities, but throughout history, would actually be an 86% retracement of the prior bull market. So if you think that seems like a long way to go down, that's really what history would say would be a normal correction of a major long-term bull market. So the bigger the bull, the bigger the bear market to follow. That may take several years. That may happen very quickly once this support level is breached. But that's really the defining point here. This is a weekly chart of the continuation of gold, and what you see is a nice hammer candlestick here on the weekly chart. And that's a nice candlestick. It is at a support level. So again, if you look at candlesticks, you look at technical analysis, it's a pretty clear long trade opportunity with a stop loss below these levels. I personally don't believe that this is going to lead to new highs in gold. I think we may get some rally, but I think the pressure from the smart money and the speculative buyers is going to be such that is going to fail, and I think that'll lead to a major decline in those markets. And I think if we look at the dollar index and we look at the data on that, I believe that supports that outlook as well. Now, specifically, as far as these hammer candlesticks, if anybody has studied Steve Nissen's work, the candlestick guru, I've heard him quoted as saying that in their studies on a hammer candlestick like this, approximately 60% of the time, price action will come down to below the 50% level of the tail. So it will come down below the midpoint of the tail of that hammer, even on a successful pattern there. So if you're looking to go long gold, here's the setup. We have the technical analysis setup. It's oversold on a weekly time frame, on a daily time frame. We're at support. We have a nice hammer candlestick. However, what you want to do is look at the daily chart, wait for the rebound to mature a little bit, wait for the market to come back down to 50% of this week's range here, and then hone in on the hourly chart. So let's say the market rallies up here a little bit this coming week, then we start to see a pullback in the couple weeks to follow, and the market pulls back to this range, then you get a nice MACD buy signal in there on the hourly chart. That's really where you'd look to take the trade. And I would say, I would advise that in this case, I wouldn't go long here. I would wait for that potential retest of the low with an actual buy signal, and then take the buy signal with a support below, a stop below that support level. So that's the analysis for gold here. Another thing I wanted to point out, really the last thing here, is if you look at the Gold Bugs Index or the Gold Miners Index, there was a flag pattern here from December to March. So if you look at this as a chart flag pattern, market broke the bottom of the flag, gap down. The target would be for the pole of the flag to project that down from the breakout point. So the market has met its chart projection for a flag pattern. So we may very well see a correction of the trend here, but could be a continuation of the trend down after that. So that's all for gold.